Good morning, everybody. I'm Bonnie Halper. I write the weekly Startup One Stop newsletter. I'll put the link in the chat. And I help founders with their pitch decks and executive summaries and make introductions to investors and strategic partners where and when necessary. And I'll tell you, if founders never know how to do their pitch decks properly. Why is that, Andrew? I've never figured that one out.
Where do
uh,
we begin?
I knew where to begin. But anyway, welcome everyone. And first I want to thank Joseph Katz for hosting us. Joseph, tell us about you and your background.
Sure thing. Welcome, everyone. Good morning. I think we all know each other, most of us. Uh, Joseph Katz, startup marketing guy. I've helped companies go from unknown to well-known, been part of some exciting exits as well as some failures. So I've learned a thing or two along the way, the good, the bad, and the ugly. I help companies with go-to-market strategy and customer acquisition sort of efforts. Happy to chat at any time. I'll put my contact in the chat and suggest everyone do the same.
Yes. And our guest is once again Andrew Ackerman. Andrew and I go way back, which is why I asked him why nobody knows how to properly put together decks. And in fact, I wonder if you address that in your Entrepreneur's Odyssey, Andrew.
Yeah. So thanks. Thanks for hitting the plug early in the in the chat. No, it actually, I've been doing a bunch of podcasts lately, and you've all when you've been connecting with people, like, the same way I tell my investors, like, always start with kind of their B-list investors first to like work on the pitch. I've been doing a lot of the kind of smaller podcasts to work on how I talk about the book. And the irony is that because I wrote the book to be kind of a soup to nuts coverage of everything a startup needs or a would-be founder needs to know about, building the startup, I can usually answer those questions by pointing to chapters in the book. So if it seems like all roads lead back to the book, it's because that's how the book was designed. So let me take a step back. So hi, I'm Andrew Ackerman. I've been investing in startups now for like 20 years now. That's scary to say. First as an angel, doing everything wrong, but getting a little bit lucky. And then in a more institutional setting, starting with DreamIt Ventures, the world's third oldest accelerator, and a VC fund. And now, I'm affiliated with Second Century Ventures, and I do some of my own SPVs, and I do like 6 or 7 other small things. So that's kind of where I'm coming from. Um, Question: why do I think pitch decks suck? Was that it? I mean, you phrased it nicer than I did.
Why don't founders ever know how to properly put together a pitch deck? I know I've seen the template, blah, 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 and they think that it's
Yeah.
called.
Well, I'll tell you kind of the top level, right? So the top level where the root cause is, you and I, Bonnie, see hundreds, if not 1,000+ pitch decks a year. Right. And we've been on the other side of the table or, on the side of that table, depending on what roles we've been in for a long time. Like, we understand intuitively what a kind of busy ADHD-ish, often lower level VC associate needs to go through to like filter stuff up and then suggest things at the Monday morning team meeting to see if like a principal or partner is interested in diving into the startup in any more detail. Most founders, especially first-time founders, have no clue what that's like. They don't know who they're writing for. They don't know what motivates them. They don't know what's going through their mind. So it's kind of hard to write effectively when you don't know your audience. So that's kind of the root cause of it. And as it's fairly teachable, right? So most founders who are not utterly lost, if you kind of sit them down and you explain, like, listen, it's all part of a funnel, right? Your elevator pitch is kind of at the top of the funnel. That's 30 seconds. And the idea is to buy 2 or 3 minutes of the investor's attention to get them to really ask a couple of questions and decide, like, do I really want to spend a half hour listening to this pitch deck, or do I want to cut my losses and move on? And then when you presumably get that half hour meeting, your pitch deck exists to get them past that next hump where they're like, yeah, this is worth a couple hours, over the next week or two to dive a little deeper, then ultimately work its way down into like, yeah, I want to dive in full diligence, maybe make them an offer. So you can explain that to the founders, and sometimes you see the light bulb go off, and then from there you go through like, this is what has to be in the deck, right? Yeah, let me just add one other thing, because this comes up a lot and it seems to be something they like in the podcasts. So as I say in the book, right, your pitch deck and your company as a whole is a chain. It's not a rope. And the difference between a chain and a rope, well, actually, let me ask you guys, what's one of the fundamental differences between a chain or a rope?
Oh, and I do want to go around and have everybody introduce themselves whenever you want to take that moment, but that's up to you.
Why don't we do that question, and then I'll shut up and I'll listen
Yes.
to everybody. So why don't just jump out, raise your hand, come off mute. What's the main difference between a rope and a chain?
One's easier to tie, it's stronger, but it's also heavier at the same time.
Okay, I like that. That's not what I was going for, Joseph. What about you, Eric?
I was
That was
Oh,
Eric.
that was Eric.
Oh, that was Eric. Oh, I thought that was Joseph. Sorry.
Yeah, that's okay. I was going to say chains have links, so they can be put back together. Ropes, once you break them, you can tie them together, but they're not going to be the
So
same.
you're closer to the right track, but that's not where I was going. Anyone else want to jump in?
I was going to say you can replace links in a chain if it.
Yeah. So that is true, and that comes in a little later. So the main difference, kind of fundamentally, between a rope and a chain is if a couple of strands in the rope are frayed and break, the rope is often still strong enough to do the job. In a chain, if a single link is broken, the chain is broken. So the idea behind a startup is you are a chain, not a rope. It doesn't matter how strong your go-to-market is or how strong the solution is to the painful problem if your market size is too small. Right? So now, as an accelerator, just to extend the analogy, we have a lot of tolerance for weak links if we think they can be fixed. But if they fundamentally can't be fixed, then the startup is a broken chain. It doesn't work at all, at least as far as a VC is concerned. So when you're pitching your startup to a VC, and your pitch deck in particular is part of that, like half hour, like, do they really want to dig in? They're looking for broken links. Like when I look at a deck before I meet a startup, I'm scanning for broken links. And if any of the links look broken and unfixable, I'm looking for the reason to ding it so I don't have to put a lot more of my time into it. So a lot of the startups, like, they have missing links, like they don't know what all the links of the chain are, or they don't know from a VC's perspective what a weak link is, and will get them dinged out before they even get to the next, lower stage in the funnel. So that's really, I think, when you tie it all together, that's like the fundamental insight that a lot of startups need to start to appreciate and to start to craft an effective pitch deck. Okay, let me shut up. Bonnie, you're absolutely right. Let's go around the room and meet people.
So Eric, tell us about you.
Good morning. Eric Becker, I'm the founder and the CEO of Millimatch. And what we've created is a organizational intelligence system. What that's a long way of saying is that we uncover through behavior what goes wrong between strategy and execution within organizations ahead of time, and foreseeable when it comes to people executing those strategies.
See, he's finding those weak links, Andrew.
Yeah, and by the way, my daughter's name is Millie, so nice name.
Annie, tell us about you.
Hi, morning all. I'm Annie and currently working for influencer media industry. And my job is to be the matchmaker between the brands and the creators. Yeah, happy to meet you all.
Good to see you. Henrik.
Yes, good morning. Henrik Leborg. I'm a fractional CFO from Toronto, Canada. So I guess in Ian's absence, I'm holding the Toronto fort down. So I work with startups and scale-ups in tech and business services. So I help them get clarity in where they are and where they want to go.
And here's Ian now.
I'm sorry?
What? And
Oh,
Ian
Ian's
just,
there now?
Ian
Okay,
just
there
joined
we
us.
go. All right.
Hi, Ian Garmes. I'm in Toronto. I work for a virtual film school. We're a consulting firm in Los Angeles, and we help growing tech firms with their social video strategy, which is pretty au courant these days. So happy to be here.
Good, always good to see you. Kevin. Oh, you're muted, Kevin.
Hey guys, Kevin McCarville just started a just co-founded a startup doing artificial intelligence for real estate. It's going pretty well. We just got post revenue, got a decent amount of headcount going. Yeah, excited to be here, guys. Thank you.
And good for you, Kevin. Good on you.
Yeah.
We always like to hear that, right, Andrew?
Yeah, I was gonna say I'd love to hear a little bit more about it, but maybe maybe as a follow-up.
Yes.
No, for sure.
And I'm sure he'll share his contact information later in the chat. Right?
Absolutely.
Got it. Thank you.
Lon.
Good morning, everybody. I'm Lon Taylor. I run a market research company called First Insights. We help both gigantic companies and startups. I'm mentoring about 4 startups right now and advising them as to how to understand their customers and interview potential people in their target audience so they learn more before spending way too much time on a startup that might not work. So that's what we do, and happy to connect on LinkedIn.
Scott, I guess you're taking time out from your busy shooting schedule, and good to see you. You're muted, Scott.
Did you call on me?
Yes, I said
Okay.
I see you taking time out from your busy shooting
Thanks.
schedule to join us.
Yeah. No, thanks. Scott Purdy, one of the founders of Sine. We're working on a product that will take multiple inputs of video or movies from any location in the world, upload them to one site and have a professional quality movie/video completed in a very short amount of time.
And Zarin. Yes, Zarin, one of these days I'm going to call on you first because it's so unfair that your name starts with a Z.
Hi. Yes. So I'm traveling from Zurich to Geneva via Lausanne. So I'm on the train. But I'm based in Switzerland, have a banking background, and currently focus on partnerships and business development, mainly in finance area, but also in AI and real estate. And always happy to participate and learn from Bonnie's breakfasts.
I'm always happy to see you. So Andrew, take it away.
Okay, so I have a couple of things I want to riff on with you guys. So first thing, since there's 2 of you in video development, I have 2 awesome interns. And for the book, I wanted to do a couple of short videos. Okay, let me roll it back. So number 1, I'm a cheap bastard, right? I did 2 startups in the past, right? I treat everything like a startup. What can you do for $1? What can you do for less than $1? So I got these interns from the school that I teach entrepreneurship at, not paying them anything. They're awesome. But if you want to use them, like I'm willing to like bill them out to you. No, I'm just joking. They're really great and they're fantastic. So one of the benefits of having 70+ investments is I know a lot of really cool founders who are doing really cool things. So when I wanted to do these videos, there was one of the founders in my network who's been very deep into different video Gen AI tools. So she jumped on a Zoom with me and the 2 interns and taught us how to do things. And Bonnie, if can I share screen and show them what she came up with?
Sure, Joseph.
And you try. If you can't, let me know. I'll give you permission.
Okay, sure, no problem. Let me give that a shot. 1 second. Says sharing is not turned on. I send you a request.
We've had some issues.
Yeah.
So,
Should I try it again? Let's go check.
yeah. You
Oh,
should be
yeah,
able
you
to.
can bond.
Here, okay, the button seems to work now. Okay, so you've done a couple. I'm just going to show you this one. Let me know, give me a verbal if you can see the screen now.
Yes, all right.
Okay, let's turn the volume back on.
That was funny.
Yeah, so there are a couple of them like that. So you can see, I have this maze motif because startups are kind of like a maze. And if you can kind of see in the bottom of the screen, which is hard to do with these, I guess I should probably turn off the my background. There's actually a picture of a guy with a chainsaw who is trying to, hack his way through the maze. Sorry, I tried to multitask and I screwed up. So hold on a second. Okay, that works a little better, right?
Yes.
So, I need to not blur that, I guess. Let's go with
possible.
none. There we
There
go.
you go.
So there's your kind of dude with the chainsaw. I'm a big fan of like puns. So you got that. so the I wanted to play with that motif. So we we played around with that. There's a couple more in my socials if you're at all curious. But the beauty of it is like after an investment of 10 or 15 hours of like experimenting with the tools that are available, with the head start that my, the other founder gave us, she's able to do these things in 20 or 30 minutes. So it's both like super scary and super exciting for people in that space because now they can do stuff they never did before at, economics that were like undreamed of, undreamt of, undreamed of. I don't know. We'll see. But that's also the second side to the sword is if your bread and butter has been traditional video production, like could be some scary times.
Yeah.
We can talk about that for a little bit. I got one other thing I want to riff on with one of the other guys who gave his bio, but what are you guys doing in that space? Are any of you finding really cool things to be done when for for your startups, or is this kind of like, it's kind of nice and it's cool, but it's niche for certain types of companies?
Are you talking to Ian and Scott?
Well, so Ian and Scott can answer a little bit more directly towards what it's doing to like their business in particular, but anyone who like consults with startups or is seeing startup pitch decks or is running a startup, I'm kind of curious if they're playing around with this or if they're like, that's not a fit for my, my startup.
Specifically
I can answer briefly. I mean, a lot of startups obviously are experimenting with all these techniques and, but there's a lot of noise out there. And for many startups, despite even having some funding, it's very, very difficult to break through the noise level. And, so people with innovative techniques, like, for example, this fellow in New York, that you may have heard of, Mamdani, use a pretty effective, social video technique, and he undercut his competitors dramatically. He wasn't using a consulting firm, as far as I know, but you can't argue with the results.
I didn't know that. I didn't realize he was doing that all in house with AI. That's cool. I mean, cool in like our city is screwed sort of way, but like kind of cool from a technical perspective.
Oh, you want to go that direction, Andrew? Okay.
No, it's too early in the morning. I've only had one cup of coffee.
Yeah.
Anyway, so the bottom line is that there's still room for kind of innovative ideas, I think, and just the obvious things that people can use with AI are not necessarily going to cut the mustard in many cases. You need something a little bit more dynamic, I think, to be successful.
I'll tell you, this was I have a not so hidden agenda in that, for that question, right? So, there's always and again, this goes back to things I write about early in the book, right? So any startup has to have a what's now to it, a why now, right? If it could have happened 10 years ago, 5 years ago, tons of people have tried it. There's either somebody like, years ahead of you, or it's kind of a flawed idea and it doesn't really work for reasons that may not be immediately obvious, but if you dig a little deeper, you can probably find out, customer acquisition or what have you. So, obviously the broad availability of AI tools that are like dramatically cheaper and more functional than they were even a year ago is a game changer. So that checks the why now box. The tricky part that I'm trying to understand with like this tool in particular is, and with others where you're using AI as kind of a tech enablement to your main business, is it a sustainable competitive advantage if you're using someone else's pickaxes? So like, does it just kind of change the industry, but it's unlikely to create huge winners because everyone can do it. And it's kind of, now everyone has better tanks, or now everyone has, nuclear weapons. So like the playing field is still leveled. It's just everyone's game has been upped. Or is there an opportunity for one or two companies to do something dramatically different in a sustained way and become kind of hugely successful and make the investors stinking rich? That's what I'm trying to get my mind around with a lot of these tools.
So the word is definitely tools, right? It's how these tools are being used.
Yes.
I think, Ian, your point about Mamdani using it to create a lot of buzz or whatnot, there are a lot of these startups in the video space or AI space they're doing some great stuff, but it's adoption, right? At the end of the day, that counts. I used a tool a number of years ago when early days of AI or earlier, and subsequently that company went out of business because they just couldn't sustain themselves. They couldn't drive the sales, get adoption. So it was a great tool. I was able to do a ton of great stuff in the short period of time I worked with them. But to your point, Andrew, I think at the end of the day, it's a tool, and the company needs to figure out how they integrate that tool into the workflow of a business, and can they get enough of a revenue stream from that to make it sustainable.
Got it. I want to pick up on something that, I mean, I take notes when you guys are talking. I think it was something that Lon said about understanding what the customer wants before they go out there and waste a lot of time. That's, putting the pitch deck aside, which is kind of like, hey, they just don't know it. It's not something I expect them to know very well, but it's coachable. One of the things, the biggest single mistake I see startups making earlier is they go off and code in a bubble. Like, they have this problem, it leads to this grand vision for a solution. They go and they isolate themselves from the world, often because they're afraid that someone will steal their idea. We can, we can unpack that later. And then they try to, like, full blown, like Athena jumping out of Zeus's head, like, unleash it on the world. And predictably, for those of us who have seen this movie before, it turns out that like 60–80% of what they build, if they're lucky, 100% of what they build, if they're not lucky, is not what the market wants. So what I say to many of them is, don't just do something, stand there, right? And I do, there are a lot of techniques that a startup can do to prevent that from happening. And I'd love to hear what Lon's are, but what I talk about kind of early in the book is what I call sometimes a Wizard of Oz prototype, or for the case of like apps, sometimes called an index card app. So the idea is, you take, you sketch out, and I purposely tell them to sketch it out rather than to make it look like photorealistic. I use tools like Balsamic. It looks like a handwritten sketch. You sketch out on like index cards the different screens of your app. And then you go to them and you go to someone who's your target customer. In this case, in the book, it's a call recording app for on-the-go professionals. So they actually start, the hero starts by interviewing a real estate agent. My wife's a real estate agent, like they live on the phones. So, it seemed like a good target. Plus I knew them really well. And yes, the agent in that is kind of a loosely veiled version of my wife. That's partly how I was able to make everyone sound different. I just have one person in mind who's that person, and I just filter everything that they say through how that person would say it. And then like presto, not everyone sounds like me. So the hero of the book, or the founder in the book, has a conversation with this realtor or real estate agent where he says to her, listen, I'm going to put in front of you index cards with are basically what the screens of the app are. And I just want you to interact with them as if they were a real app, right? Touch them, right? Touch what button you think you want to do next. And I'll give you a different app, different card, depending on what what you press. And he said, I'm not going to say a word because I'm not going to be there when you download the app. So I'm not going to say anything. I'm just going to watch you. The only thing I ask that you do differently is verbalize what you're thinking, because I can't read your mind. And in the process of doing that, you learn, like if you do that for 20, 30, 50 people, you learn what parts of the app are confusing to people, right? What do they never use? And that could be a UX thing, or it could be hey, they just don't really care about that feature. And you learn all of like, where you need more, right? So you let them do that. And then you kind of debrief after. I see you never went over there. Why not? And so I didn't see that. Well, that's a UX issue. Or it's like, yeah, that's not really an issue for me. I don't care about that. Or I would never trust the app to do that for me. And then you learn like those features aren't relevant. So just don't build them. Right. And then you can do other stuff around like, I didn't do that because I was kind of confused. I was afraid that if I did this, something else would happen. It's like, okay, so you're going to work on your UI a little bit and your onboarding. So it's a really, really powerful tool that costs you less than $1 in index cards and materials. And if you want to be really fancy, you buy everybody a cup of coffee while they do it. So like, now it costs you $8 per person. Because, don't be cheap on the Starbucks lattes. And but you get like invaluable information that saves you months of time. And I've got a couple other real life stories around how you do that in other contexts if you're curious. but it will literally, and in 2 cases, I know literally did save companies that I worked with and that my fund was invested in from crashing and burning before they even took off. Cool. Lon, I saw you message something. I don't, when I get on a roll like that, I can't always read the chat, but why don't you come up mute and share that with the group?
Sure. No, I was just I just messaged my LinkedIn if we're not connected already. But yeah, look, the importance of talking with the target audience, you know, at the very start of going down a startup road is just, to me, it's something that seems like common sense and that would be critical to founders, and yet they don't think about it, or they don't know how to do it, or they're terrified of actually talking to their target audience. And so I work with Florida Atlantic University, has a really great startup program called the Tech Runway. I think there's about 150 mentors involved now, and they modeled it after the MIT program. And one of the things that they found out a few years ago was that, you know, they're trying to vet startups and see if they can get into this bigger program. And they found that a lot of startups just weren't ready. And it was a lot of pie in the sky ideas that, you know, they want the school to have a good reputation where some of these startups actually get funded and go to the next level. And so they said you have to interview 25 people to even apply to get into the next step. So then they realized last year that people didn't know how to frame the conversation or how to find people in their target audience. So they brought me in to run a workshop with about 30 startups, and it was great. And it's, you know, something that I take for granted because I've been doing this for 20 years.
Yep.
You just realize that all these startup folks, you know, some of them may be younger, some were older. It didn't matter the age, but it was just, they didn't know how to implement it.
Yep.
And so we built a little bit of a framework for them, and then let them go. And then they could call me for advice. You know, how do we, you know, how not to ask a yes/no question for certain things.
Open-ended questions, don't guide them.
And is it, you know, how to ask the value proposition question versus a functionality of, you know, maybe an MVP that they've built question. So all these things are super important, and you see the impact and listen to the founders once they actually do these interviews and complete a bunch of them. It either makes them depressed and they they know not to waste, you know, months of time, or they get really excited and they're like, yes, I think we have something and we just need to tweak this, this, and this, and then we can go to the next level. So they gain more confidence in their decision-making powers, either way, positively or negatively, start speaking to people. So it does work, and it's a great way to move your startup forward.
So a couple of things I want to highlight, or plus one there. Like, yeah, some of them are afraid of customer introductions, and the ones that resist it, that's a great acid test, right? Those are founders we just don't back, right? They're not coachable. They're not afraid of, they're afraid of, actually, I'll tell you a quick joke that I sometimes do, because sometimes humor breaks through a little better than just telling them. So there's this old guy, and it works better if it's an old Jewish guy for some reason, in the middle of the street at night, like looking down. And his buddy finds him and says, "Hey, what are you doing in the middle of the street at the middle of the night, like staring down at the pavement?" He goes, "Well, I lost $20." It's like, "Oh, okay, I'll help you look for it." So they look, and you know, they're in the street. And after about, like, I don't know, a minute, because like it's the middle of the street, there's not a lot of places for a $20 bill to be hiding. He says, "Yeah, I don't see it. Where exactly did you lose it?" So the old guy says, "Down that alley." And he said, "Well, if you lost the $20 down the alley, what are we doing in the middle of the street here?" He goes, "Well, the light's better." So a lot of founders retreat to where the light's better. Like if they're programmers, if they're technical, they retreat to building features because that's what they're comfortable with. And like talking to customers, to them is a scary dark alley. So I use that a lot. I get a couple of courtesy chuckles, but more importantly, like the founder kind of sometimes gets it. And if they still don't get it, like, you know, whatever, it's not going to happen. But I do the exact same thing in the course I teach in entrepreneurship. First part of the course is you got to do customer discovery. So amen. Oh, and by the way, if you want to connect with me about that later, I also do guest lectures. I don't charge when it's part of an entrepreneurship program. And I have a whole presentation about customer discovery, if that would be helpful. And if there are people that are teaching entrepreneurship more, more systematically, I actually use my own book as part of the curriculum in class. And it works really well because, it's written like a novel, so it's not this boring textbook that you kind of have to plow through until your eyes glaze over. And each chapter maps really well onto a different topic, like customer discovery, your problem slide. A lot of them map very closely to slides in the ideal pitch deck. Bonnie knows that. And then the last bunch of chapters is all about like how fundraising actually works. So if that's of interest, we can connect about that separately.
I just wanted to add, if one more person starts their problem slide with, fintech is broken.
Oh, I hate these.
It's like, is that where you stop too? It's like, oh, come on.
So who here remembers Dave McClure?
Of course, I saw
Of course,
David.
Bonnie, you know everybody. Okay, it doesn't count. I knew you knew him. So he was the founder of 500 Startups. He had a Me Too problem, and he's kind of gone underground, I think.
Oh, no, he's still very active.
He's back. He was very quiet for a while, which is very unlike him because he's a loud guy.
Yep.
He has a very, very cool deck. If you want to go Google something, it's called Startup Viagra, How to Give VCs a Hard On. It was one of the earlier decks about how to create an effective pitch deck. It is vulgar and crude, both language and the art, but it's actually pretty damn good. So he was at a pitch event, and like all the founders are coming up with X is broken, or our visions. And he's just like, at one point, he's like, what problem are you solving? And they like stumble for a little bit. And like, no, really, what problem are you solving? And at one point, he's so frustrated because like startup after startup starts with like X is broken, blah, blah, blah. Or we are a group of rock star ninjas, whatever. And I said, listen, I'm not listening to another pitch unless your pitch starts with the problem we are solving is. And next startup comes up, says X is broken, goes, stop. Problem you are solving is. And he does that over and over until they actually start doing it. And it's a little bit like, it's like watching like a newborn like deer start to try to walk. It's all shaky and wobbly, but he actually gets them to start their pitches that way. And it's actually very cool to watch. Now, he uses the F-bomb a lot more, when he did that, but, it wasn't integral to the lesson.
I wanted to share one thing. So before Millimatch, I had 5 previous startups, but on the third one, it was the head of a VC firm, and I said, I'll send you my pitch deck. He said, I don't need a pitch deck. He said, 2 questions. Is your product a nice to have or a need to have? And he said, let me just fast forward. Everybody says it's a need to have. Tell me why it's a need to have. Why it's a need to have for me and to your clients. And it was simple, but I stumbled through it. And he said, sounds like a nice to have. This was my 3rd company. And he goes, what I'm interested in is a need to have.
Yeah.
And if you can't articulate that, you're not going to be able to articulate that in a pitch deck, and you're not going to be able to convince me. So from there on, I looked at my companies. Is this a nice to have or a need to have? So
sure, no. You sometimes hear that as, is it a painkiller or is it a vitamin? We sometimes put it that way. We don't invest in vitamins, we invest in painkillers. I actually, I try to put a little bit of rigor around that. It's in the presentations I give. It's also obviously in an early chapter of the book where I talk about the problem slide. The problem has to be painful, ideally on 3 dimensions. And they are the intensity of the pain, right? It should be like, oh, I just hit my thumb with a hammer, not I got a hangnail. That's number 1. And that's what most people will focus on. But there are 2 other dimensions that are equally important. The other one is prevalence, right? Is it just you, or are a lot of people having the problem? And the last one, which also is often overlooked, is frequency. Does this happen every day or every month? or is this the kind of thing that happens like once in a lifetime? And I'll give you an example to illustrate this. College admissions. So college admissions, the whole college process. I have one kid that's a freshman in college. I got two more that are rising juniors. I'm living this hell. It is an incredibly stressful time for them, right? They are being asked to make a decision that will affect their life based on utterly inadequate information and information overload. So super painful. Okay, score one. Number two, most people, the overwhelming majority of people in this country do go to college. So it's a very prevalent problem. So score number two, great. Problem is it happens once in a lifetime, maybe twice if you include business school. So it scores very low on the frequency. So startups that come after like that market, that's where I push, right? Because I got to make their money not only like on that one bite at the apple, but they've got to get the potential customer at just the right point in their life cycle to capture that pain point. It's not like, oh, it'll happen next month. So when I think about like, are you a painkiller or a vitamin, or is it a need to have or nice to have? I try to score the problem on those three dimensions of pain.
Oh, by the way,
No, that makes a lot of sense.
Zarin put a question in the chat. She's traveling, so connectivity is weird. So
okay, it says, what difference, if any, created in your investment approach starting as a founder versus someone's pure investor background? Okay, so that's interesting. Bonnie, you and I are old enough to have seen a shift in the VC world, right? So
yeah, thanks. It was my birthday, Andrew. Thanks for that.
yeah, but like I didn't call you out on what number it was.
No.
I did give you like the obligatory Facebook post.
No, I appreciate that.
Yeah, thank you. And then you have to wait till the end of the day and give the obligatory thank you, everybody, for your wishes. And then like the algo is happy. So when I first started out, my first startup, the majority of the VCs came from pure investment backgrounds. There weren't that many people who had done prior startups because being a startup, I'm an entrepreneur. Oh, it means you're unemployed, right? It just wasn't really a thing. And over the years, the proportion of investors who had a startup or two, either as a founder or having joined at the seed or A round, has gone way up. So, I think in part it's because it gives them a bit. I don't think it's because they're better at investing, to be brutally honest. Your ability to create one really good startups is not necessarily a strong indicator of your ability to source startups at scale, assess them quickly and decide which ones are just not worth your time off the bat, diligencing them in great detail. Like, I don't think it's a great indicator, that sample size of one. Where it does come in handy is that last stage where it is connecting with the founders on a level that makes them want to take your money over someone else. Say, hey, Bonnie, I lived what you're doing right now, right? I know exactly how it feels. I'm not coming at this from pure dollars and cents. I'm going to be in your corner. And that appeal, that works, right? For a lot of founders, when they're on the margin between two term sheets and the terms are kind of similar, they go with the people who they feel know them better or are more like them in that regard, rightly or wrongly. And I think it's come to the point, though, where like the majority, maybe even the vast majority of people in the VC world have some kind of startup background. I don't have any data to prove that. So it's kind of evened out at this point, right? I think you'd be, to the point where like you'd be at a disadvantage if you didn't have it, or maybe it's so rare that you didn't have it, like founders don't even know to ask because everything else evens out. I don't know. But that's one of the big changes that I've seen. On a personal level, I probably spend too much time with my startups that are not going to make it or are not going to make it big, right? I've been through it many, many times. Both the two startups I created and the one, the hundreds that I've backed. And from a purely rational perspective, I should really be investing I should be investing most of my time either in finding new investments or helping the 1/3 roughly of my portfolio that's, on the verge of killing it. Knock wood, if that's, if I'm that lucky. And I really shouldn't be spending much time at all on the startups that are struggling or that are going to take too long to, even if they make it, generate a good ROI. I just shouldn't be doing that. But
See, that's the accelerator managing director in you.
well, you do it early, but after that 3 or 6 month period, if they're like kind of stumbling or going sideways, you're on to another batch. So you often don't have that time. You don't make that time. But I've lived with it for long enough that like I just can't do that. So I got companies that are, they may still break through, but after 5 years, the ROI just won't be there unless maybe I invest only in that later round.
Andrew, quick question on that. How do you identify the ones that are not going to make it? What are the signs that you see?
Well, if I've been working with them for 3 years and they're growing like, 10, 20% a year, that's not VC growth path. And in part, it's just not a VC growth path in general, but it's also an indicator that something about their startup is not that compelling to the market. Could be a vitamin, not a painkiller. For the first year, maybe it's just how they're doing it, right? Maybe they're just doing it wrong, and we can tweak the, we can tweak the model and make it work. But after 2 or 3 years, you've gone down the list of things that you think are going to move the needle. And of course, if you're rational, you start with the things that you think are going to move the needle most, highest likelihood of success, and you work your way down to the other stuff. So after 2 or 3 years, if it hasn't moved the needle yet, like you're at increasingly into Hail Mary territory.
Following up on that, what about companies that have technology, but you need the time to take and develop it and to pilot it, to get feedback, to further develop it, to find that sweet spot? Do they get a pass or no?
No one gets a pass because my LPs don't give me a pass. Right? The question is, are they doing that in a normal timeline for a startup, right? If they're stumbling around in the dark and they're not going out there and figuring that out within like a year or two, then like A, that tells me something about the team, and B, like they're just not going to generate the revenue and the returns and the success in the time I'm thinking. Now, on the flip side, if they've been wandering in the wilderness for 5 years and then I meet them, but now something has kind of flipped the switch. We just figured out what it is. We changed our revenue model, and now things are really starting to hit. I'm okay with that because that's not my money that's been idle for 4 years. I'm coming in. Everything else in the past is sunk cost.
Gotcha.
Kind of sucks for their prior investors a little bit, and it might impact their cap table, which would be a problem. But if I can get on the right stage when they're at that inflection point, I'm cool with that.
Andrew, there was a question. Oh, sorry, Eric. Go on.
No, go ahead. Go ahead.
Sorry.
Please.
Andrew, there was you touched a very interesting point because we do have a project with a startup that they patented a product in 2016. They've been idling left and right. It is a very promising product, promising tech. And we got involved through a couple of investors into this tech. And I do see the potential into this technology, huge potential. It's just that it is run by a highly technical team, PhDs, which they are very good sometimes to develop the product. But then when you have to build the value proposition or the commercial strategy, there is some work to be done. And what we're facing right now, it is an incredible obstruction from the current shareholding, from the current cap table. Yeah. They still anchored to absolutely unrealistic company valuation that have any sort of foundation. And we're still in negotiation with them. So on one side, you have this passion thing that the potential of that. It could be something huge. And how to reach that. You have it clear in mind. On the other, you have this massive obstacle of the cap table, of the current cap table in front of you. How
I
do you
think
deal with that?
I think there's
Yeah.
more than that, because you mentioned there's resistance to them. They're a technical team. I don't know if you were here for the joke I told earlier, but they're still like playing where the light is good. They're not going down the dark alleys where they really need to go, which is scary to them, but that's where success potentially lies. And if you've been struggling with them for a while, you have a problem with the team, and you can't get past that. Like the mistakes that I've made that I've learned from, as opposed to the ones that I've made and I'm not learning from, is I never fall in love with an idea and overlook misgivings about the team. Like, yeah, you probably all heard the like, hey, do you bet on the jockey or the horse, right? And I always thought that's like a bullshit question, because I used to be really into horse racing. I've never seen a jockey win a race without a horse, and I've never seen a horse win a race without the jockey. Right? It's nice visual there, right? I'm actually going to I'm speaking at an event later this month in Saratoga Springs, so I'm finally going to see that race course. It's got to be both, right? And if you have a founder who still has a huge chunk of the company and they don't get it, right? After a while, they're just not going to get it. So you have to like rip yourself away from the idea that you love, because it's just never going to succeed. Now, I say never. VC, anytime you say never, there's always an asterisk. So, the only real asterisk there is like at some point, maybe the world has kicked the crap out of them long enough that like they're willing to learn. Or it's kicked the crap out of some co-founders long enough that they're willing to leave and be bought out. And then the right guy can come in. I had this conversation actually just yesterday. There's a startup, very, very cool. They do cross-border real estate transactions. So like if you're in the EU, which from your note, Francesco, you are, I think, are you based in the EU?
We in the UK at the moment.
Oh,
yes.
in the UK. Well,
yes.
Okay, not technically the EU, but okay, Europe.
Yeah. Well, we have to be precise around here.
Yeah,
you do.
For the past couple of years, yes, you have to be.
Everyone that breaks it.
Yeah. So if you're an investor, let's say you live in London or Birmingham and you want to buy property like a summer home in Miami, the problem is that like your bank in the UK doesn't know how to underwrite a property in the States, and banks in the States have no idea how to assess you as a borrower, because different credit scores, that's not their business. So this company called Lendai, Lendai, is able to underwrite those kind of cross-border purchases so that you can actually get financing. You don't have to do an all-cash deal. Now, they'd been around for a while, and they kind of went sideways for a bit because initially they were a tech-enabled lender. They had raised the money to be that lending institution, and they were using this as their tool to segment, to go after that target segment. And the interest rates turned on them, and they had a shitty portfolio, which happens. But since they were all one company, it made it impossible for them to raise money separately for the tech part of the business. So, they made a cardinal mistake. They didn't do an opco-propco structure, which would have insulated them. But the underlying issue is that two of the original three founders, like, kind of just didn't get it. One was a lawyer, one was, more on the financing side, wanted to take that angle. So I had introduced them to a different group. Long story made short, one of the guys wanted to invest and then buy in, and two of the other founders would then kind of step down, and he would replace them. So that's a situation which could work for you, Francesco, if they're willing to do it. But you need to also have a recap, unfortunately. So all the prior investors have to be on board. Often you'll set up a new company that'll buy the assets from the old one to give it a clean start corporate-wise.
Yeah.
Then the prior investors get pieces in the new company, and they take a haircut and you fix the cap table.
Yeah, that's a very good idea, actually. The clean slate.
Forward.
Yeah, the clean slate is a very good point. Thank you, Andrew.
Yeah. I try to end on a high note, even if it's, small likelihood of working for you. By the way, I saw your note on the side. Do you want to tell, since you didn't get here in time for the intros in the beginning, do you want to take a moment and tell the people what you're working on the sustainability front, and maybe even talk a little bit more about your podcast?
Sure. First of all, thank you for having me. Didn't.
Don't thank me.
I was a little
Bonnie
bit.
and Joseph.
Thank you, Bonnie. Yes, thank you, Bonnie. So I run OBI, which is a sustainability consultancy. We are specialized in life cycle assessment and climate techs. So we help both startups and investors to validate the technology, which in a very simple word means that they're not claiming bullshit in their environmental credentials and targets. We do have, let's say, a very thorough approach in studying the environmental returns onto that. We also host the Raw Green podcast together with a dear friend that she works for a firm, a fund here in UK. And we talk about anything regarding sustainability and climate technology, from obviously a broad varieties of clean techs, from wind assisted propulsion, biochar, to biodiversity, to policy, literally everything. We try to bring out a positive message about sustainability, a happy message about sustainability. It is not just bloody bureaucracy. It's not just a bloody cost, but it is an investment, and as such, has to provide a return, both financial and environmental. And that be it.
Very, very cool. Have you ever come across a company called Flower Turbines?
No, I haven't, but tell me everything
They're
about it,
based in the
please.
States and in the Netherlands. They do vertical turbines that you can actually put together on rooftops.
Mm-hmm.
You know, the turbulence is actually a plus. It doesn't decrease efficiency. And they've been used in everything. I guess in the Netherlands, they've been used a lot on like those e-bike charging posts. So that, you know, you'll have like a solar panel and a little small mini wind turbine. They're a
Yeah.
portfolio company of mine. I think, you know, they could be, you know, if that's not like less cool when you're dealing about robots for like seaweed farming or space solar, I mean, those are really cool. But if that's
Oh
interesting,
wow, you check it out.
so of course I multitask. I'm happy to
Wow,
make that
yes.
intro for you.
Well, look, we would love to work with any kind of technology, and vertical axis mini wind, it is absolutely phenomenal, and it is one of those technologies that they've been around. Actually, I think the very first patent was like in the 60s on vertical axis wind turbine, and for residential usage, they make even more sense than solar in so many areas.
In many areas, absolutely.
Yes, they do. They really do.
I'm gonna put their I put their website in the chat for you, Francesco. And if you're interested, just message me. You can all, by the way, you're all welcome to hit me up on LinkedIn, but do me a favor, because I get so many unsolicited friend requests on LinkedIn. Like there, you know, some guy in Lagos, Nigeria, who sometimes is actually legit because I work with their prop tech group out there, but most of the time are not. Or dental hygienists in Cleveland, which are always like not relevant. Just throw something in like follow up from, you know, Bonnie / Joseph's, you know, breakfast. That way I know that like, oh yeah, we did actually talk.
Yeah, I always encourage people to do that. By the way, Zara just mentioned in the chat that she's working on renewables in the Czech Republic. That's also EU supported.
Hey, you know what's something cool about the Czech Republic? In theory, I can get Czech citizenship through my dad. I haven't done it yet. I contacted them like right after the split to, you know, I was a consultant at the time and we were kind of between projects. So I said, hey, you know, what are the laws? And like you can absolutely get citizenship through your dad. He was there for like 2 years. He was in a DP camp essentially. But like, yeah, that's cool. You can do it. But we don't recognize dual citizenship. This is back in the 90s. I'm like, yeah, I'll come back to you later. And I never did. But like in theory, I could get a third passport.
That's always good.
Yeah.
Yeah. Hey, like, you know, passports are always good to have.
Yeah.
Yes. I have two. But yeah, it's very helpful to travel.
Lon, you raise a good point. You only have 5 free notes. So you can send me an email, or, you know, Bonnie, if you want to share my
I'll share it to the attendees. I'll share your
you can share my email address.
Your
My
email. Okay,
address
I'll do that. Okay. I always have to ask you first, don't worry.
No problem. Happy to. Anyone that's on this call is welcome to reach out to me directly. And instead, just put in the subject line, you know, follow up Bonnie/Joseph's breakfast Zoom.
Okay.
Hey, Andrew, I have to run for another meeting, but very insightful. And I've been
Thank you.
through a lot of these and everything else, but your talk was clear, no BS, and I appreciate that. But
I
as long as
appreciate
I've
that
done
too.
this, I did get a lot of insight from you. So I thank you,
Appreciate
Bonnie and Joseph. Kudos for having Andrew on.
My only ask is, take a look at the book. If it looks interesting, post it to your network, please, because everyone here touches a lot of startup founders, would-be founders. So those are my audience. If you want a little bit more about me, I usually say this at the end, but Eric, since you got to go, I'll say it now. My personal website, which is a work in progress, is Ackerman.com.
Gotcha.
Is the book downloadable? Yes, there is a Kindle version. It's on Amazon. There's 3 versions. There's the Kindle version, the paperback version with the very cool cover I was telling you about. And there's a cool story behind that. And then there's a hardcover for $190, which I fought my publisher about. Apparently, it's like the super durable library version, and it's got a shitty blue cover. They won't take it off Amazon. I've talked to other authors that Routledge publishes, and they're like, just give up. It's going to be there. Only 3 people have bought the hardcover. One is my mom, after I told her repeatedly not to, but she did it anyway. And the other 2 are shockingly the British National Library and the Israeli National Library.
Andrew, are you willing to fund those people that are on this call so that we can buy your book? Just a fund of like $200.
Usually it goes the other way around. So my current investment thesis is focused on real estate and construction tech. And I usually invest at the post-revenue pre-Series A level. And Second Century Ventures, who I alluded to earlier, is the VC arm of the National Association of Realtors. They have programs in Europe. It's called Reach UK. It covers all of Europe. They've got 2 in the US. They've got LATAM. They've got Australia, which covers all the Pacific Rim. They have Israel, and they have the Middle East, which is everything but Israel, and Canada as well. So like really anything in the space that's tied to real estate or that makes a real estate agent, a realtor, more effective, helps them close more deals. Like those are all stuff that are in scope, and they go even a little later than I go personally. They'll do anything kind of leading up to, say, a Series B. So if you do have companies or you work with companies like that, absolutely tell me about them.
Gotcha. I was just looking for a $200 bridge loan so I can buy your book. That's all,
Well, if you buy the trade paperback or the Kindle version, you only need a $35 loan.
No, I want to be the first one on the block to have the hardcover. So
where do you live again, Eric?
In Texas, outside of
Austin.
Okay.
No one in Texas, to my knowledge, has purchased the boring blue cover, absurdly priced hardcover.
Well, there's that reading curve for us outside of in the rural areas. So.
No worries.
Thank you so much, Andrew.
I put a link in the chat, which includes our 25% off discount.
Yes, and if you use that, it is not $35. So there you go. You don't need a bridge loan for the full 35. Now you only need a bridge loan for like 22 and change or 26 and change. I can't do that math in my head.
Andrew, Bonnie, I gotta go too. Thank you very much for having me. It was a pleasure. It was really insightful. So thank you very much. Let's keep in touch after.
Yeah, sure. Well, I will send this email to everybody.
Wonderful. Cheers.
What else? We got another couple of minutes before I got to go to my next Zoom. Any questions?
Yeah, any questions? Anybody else want to?
Oh, I'm very curious about what kind of prop tech projects you've been investing in. I mean, I know you said a bit about it, but like I'm working on something myself, and I'm curious.
And what else are you focused on besides prop tech, Andrew? I'm sure everybody wants to know that too. But prop tech first, sorry.
Yeah, prop tech and construction tech, I'm pretty tightly focused on. I mentioned one of them, like Lendai. That's kind of a cool company.
Right.
Let me go for like kind of a broad range. So one of my other investments, which I got through Dream It, and then I did my own SPV for their up round, was called Ko-Fi.
Yeah.
So for those of you who are familiar with construction financing, you get a loan, you'll be a builder, you maybe need $1 million, $3 million, this is a small, mid-size end of the market. You need a couple $1 million to build a property. Maybe it's like a, 3-4 story, like 4+1 type, multifamily, or maybe it's just a very large single family home. You go to the bank says, great, you have a loan, and they'll give you the money all at once. They give it to you in tranches. They're called construction draws, like 25% at a time. Process is slow and painful, and you used to have to do faxes and emails. So this company called Ko-Fi comes up with a solution that makes that process smoother for the banks and starts like selling it as SaaS. I meet them and I'm like, hey guys, like, this seems like a huge time saver for the builders if you thought about doing a builder focused product. And they're like, yeah, we'd love to do that, but we're a small team. We don't know if that's really to use what we talked about before, a massive pain point for them. Would they pay for it? And I said, well, if I can get you in front of a dozen or 2 dozen, builders and GCs, would that help you put that to bed? And like, that would be awesome. That's how I lured him into our program, by the way. I'm a firm believer that VCs are kind of hypocrites. We tell our startups they have to be like a quantum level better and visibly and obviously different from the competition. And then we go out there, it's like, hey, we're 2 exited founders with great networks and we can help you out. And like, just like every other frickin' VC they've talked to, just a different logo. So at DreamIt, we had built like a whole program, a platform on the acceleration side. And one piece was 2 weeks of customer sprints. We had a network of these builders, developers, realtors, real estate agents, architects, et cetera, property managers, who every time we had a cohort of 6 or 7 startups would come and they'd look at them like, I want to talk to those 3. So they have a qualified sales leads if you come from an enterprise sales environment. They'd be sit down face-to-face meetings in person or virtual if they were like Texas or Chicago, which we usually didn't get out to physically. So I'm like, hey, I can get you like 20, 10, 20, qualified leads for you to talk to. And like, that's awesome. Let's do it. And they came out of that program and said, Andrew, we made 3 decisions. It says, number 1, oh my God, yes, it's a pain point. We've got to do this. So thank you for helping us put that to bed. We ended like, a year plus of them like arguing about it internally in 2 weeks. Number 2, what we've learned is it's really best focused on the small mid end of the market. There are solutions for the very high end that get them like maybe half of the way to what we do, but it's just easier to sell something that's 100% improvement than a 50% improvement, especially when the guy internally just like put his reputation on the line. We got to make it work with these guys. It's going to be at least 2 years before they admit that they don't like that and they need something better. And the third thing we realize is we're totally flipping the model. We're not going to charge for the software anymore. We're going to create a marketplace where we match the builders who frankly don't care where they get the money from if they can get a draw in a week or less, with the lenders who are just starving for any kind of leads. And we're going to take an origination fee and a servicing fee. And like, it's been hugely successful ever since. So that's to give you like a, kind of more of a fintech-y version. And I believe like maybe about 30+% of my startups are overlaps with fintech. They fit in either market or their go-to-market. Their revenue model is very fintech-y. So I had another one just to give you another, and I'm only going to leave like these, one more example. It was a 3-sided marketplace around hauling low dollar value relative to weight materials like gravel, asphalt, that kind of aggregates in general. And they had a solution for people that were shipping it out, people that were receiving it, and for the actual haulers, the trucks that were carrying it. And any one part of the market worked well on its own, but when 2 or 3 parts were all using, it's called Rocket, it was just even more awesome. They used to show up at conferences and they had T-shirts that says, if you're not using Rocket, it's your own damn asphalt. Like, fun guys. They were acquired by a company called Command Alcon. But the reason I brought that up in this context was, they had like, okay, here's our revenue total addressable or subtotal addressable market from, not at SAM or SOM, that's bullshit, but from, product A and, for the shippers. And here's our, our total addressable market from the product that's addressed to receivers. And here's it from, the haulers. And by the way, here's this other total addressable market where we're going to be factoring the receivables for the haulers. And the first couple of markets were 800 million, 200 million, 100 million. And then like the fourth market is 5 billion. Right? The fintech rev model that they could do, which actually had to be powered from the insight they got from the hauler and the shipper, because then they knew like those shipments were going to be approved, opened up a market that was 5 times larger than any of their other verticals combined.
Wow.
So I see that a lot where like there's a fintech model that is a better way to monetize what would otherwise be SaaS or something else.
Gotcha. That is really insightful, and thank you so much for that. Yeah, I mean, the project I'm working on is probably not like those. It's not a marketplace. I mean, marketplaces are famously considered to be difficult.
They are
by a lot
horribly difficult, but they are super defensible.
Yeah.
Like, who's looked at Craigslist lately? Craigslist is still butt ugly 25 years later, but still like one of, if not the best place to go and sell stuff.
Gotcha. That is very interesting. I'll definitely be looking at those examples. Thank you for that.
My pleasure.
Yeah.
Andrew, I think the Craigslist example, it goes back to your index card, right? It doesn't have to be so sophisticated.
Yeah. So the thing is, like, I'm often a little surprised that it didn't like, once they had product market fit, they didn't like clean it up. And I have 2 theories about it. I don't know Craig. I assume his name is Craig. I don't know Craig, so I haven't ever asked him. So I think 2 things are the case. Number one, the market's so like a marketplace is such a defensible market model. Like, I want to sell something. Why would I go anywhere other than the place where all the buyers are? I want to buy something. Why would I go any place other than where all the sellers are? It's so hard for other people to catch up that despite butt ugliness, it still works. That's theory number 1. And theory number 2 is the solutions that we think are more elegant, prettier, don't always perform as well as butt ugly does.
Right.
I think you know Brian Hecht. Until very recently, he was one of the partners at Roundtable Accelerator. He's kind of doing his own thing now. He his first startup was around helping actors get classes or gigs. I don't remember the details. And I had him come in to speak to our accelerator cohort at one point around UI, and he put up like 2 slides. One was like one version, the kind of the really butt ugly version of their site, and the other was like a very clear version. He's like, which one of these do you think we used first, and which one do you think is our current site? And like everyone chose like the pretty one for the current site. It's like, well, a little bit of a trick question. We did originally start with the butt ugly one. Then we tried the better site and it converted worse. We went back to the ugly version. Right? You always have to A/B test. So it's not always intuitively obvious.
And I'll just echo that for a quick second. I never will forget this. Kaplan days, you remember. We did a marketing campaign. It was rushed. It was last minute. It was the ugliest thing I've ever seen. And from a marketing guy, it's saying something, and it performed 4 or 5 times better than anything else we had done. So I know a lot of people that go, it's not polished. It's the look and feel is like maybe 20% of what's going to make people jump to the next step.
And sometimes the roughness is actually a bit of a feature. It seems genuine in some ways. I'm not a great designer, right? That's not my skill set. In fact, when I did the book, I actually got to work with another one of my former founders, who I always loved, and I always kind of referred business to him in the past. I'm like, Frank, I finally have something for you personally, that I would do. And we worked on this, and my approach to the cover. So number one, I kind of worked backwards. I went into a Barnes and Noble, and well, actually, let me give you a little bit. My publisher was giving me like some stock photos, and I'm like, those all look very business booky and textbooky. And like, I purposely wrote it as a novel, so it didn't read like another boring, bland business book. I purposely did it differently because the world doesn't need another same old business book. So I want a cover that is as different and, quirky and like stands out as the content of the book itself. So I went into a Barnes and Noble And I just I stand in front of the business section, I let my eyes kind of unfocus. And the first thing I'm looking for is what colors are underrepresented. And shockingly, green is underrepresented in the business section. That's the first thing I noticed.
Wow.
The other thing I noticed is if you look at them, there was like 2 or 3 kind of templates for a business book. Most of them were standard primary color as a background, often white, but it could be like a blue or a shade of like muted red or some cases very, very light greens, but that was a little rare. And then on, in that field, it would either be the picture of the author or maybe like a visual pun, like, oh, the strength of networks, and it looks like you've got like an old school light bulb, and then it's broken, and inside the light bulb it's a dandelion, and it's blowing away. Or it's like a roll of $100 bills on a fish hook. It's about marketing hooks or networks in the first case. So I go, that's interesting. I want to do everything but that. So then I walked over to the sci-fi fantasy section. And I kind of looked at those, and I'm like, a lot of them had on the spine of the book the image of the character. I'm like, oh, that would be kind of cool. I went back to the business section. All the spines of a business book are plain background with like, monotone words on them. So I'm like, interesting. My book wasn't thick enough to support that image of the character, but we ultimately came out with, this kind of motif. I have to unblur, I guess. I keep doing that. So the idea was a couple of things, right? So the idea behind this is like, this doesn't look like a business book. Like, in fact, I show it to people like, it looks kind of like the Gary Larson Far Side cartoons. That's on purpose, right? I wanted people to come in and see it and say, that's in the wrong section. So it would jump out. The other thing I did is real closely, I carry the maze motif around on the spine. So like it stands out even when all you have is this. Now, here's the irony. It's not actually physically in stores yet. Physical stores follow online sales, and it's just started to sell. But I was thinking about that. The actual words are in white on this color background, which was no one else was doing that. And I carry the maze over to the back side. So, I went at this with the help of a really great designer, but I purposely chose something that would zag where everything else there was zigging. So, we'll see. Maybe I put a lot of time into it and I was wrong. You can't really A/B test the cover of a book, unfortunately. But when you're looking at design, don't just take your designers like, oh, this is so much better. You have to be thinking about it in, what's it up against? And also, can we A/B test this in some ways before we really commit to anything big? Thank you. Thank you, Ian. Appreciate the compliment.
Now, Annie has a question.
Yeah, and Andrew, thanks for sharing today. My question is about how do you help founders identify the moat or unique edge in their category? Since you mentioned about to find the pinpoint and what user needs, but I would like to know more about it.
Yeah.
Thank you.
So, having a defensible strategy model is one of the links in the chain, right? If they don't have that, the chain's broken. So if they don't have it to begin with, like, listen, stories, analogies, those are always easier ways to get things across. It's why I chose the approach in the book. So sometimes I tell them, listen, you're climbing a ladder. Other people are climbing behind you, right? I don't want your answer to be, how do you stay ahead? Oh, we're just going to keep climbing faster and faster. Because ultimately they'll catch up, especially since now they know where to go. It's easier. I want you to tell me how you're going to kick the ladder out from under you so they can't follow you. So marketplaces are great that way. Sometimes the data is the advantage. Like take Netflix, for example. I could copy every line of code of Netflix, but if I didn't have that wealth of consumer behavior powering the algorithm, it's just not as good. So like Netflix gets better and gets progressively even more better over the competition, the more it's grown. So those are kind of models that matter. I've become a little bit more sympathetic to like, hey, we're going to get out there. It's a land grab. We're going to be the name, and like consumers can really only remember 1 or 2 leaders. I don't do as much B2C anymore, so it doesn't come up with me that often. But if a startup can tell me like, listen, I get it, like 3 years from now, anyone can do it. And by the way, anyone can do anything given enough of enough resources. Like you just want it to be far more painful for, say, Amazon to try to recreate what you're doing than just buy you. I mean, that's really where you're going with it. But if they come to me like, listen, here's our plan. We're going to get huge super fast. It's credible. And then by the time anyone comes in there, that kind of brand recognition is kind of that leg up. Maybe if that's their startup. But I'm pretty kind of anal and aggressive about like not investing in startups that are relatively easy to copy. That goes back to what we were talking about earlier in the conversation with video AI.
Thank you. Much appreciated.
Thanks.
So what other things do you focus on in terms of investing? You look prop tech.
Oh, sorry. I thought you meant like looking at the deck. It's every link in the chain. So it's usually prop tech or construction tech these days. And the reason I focus that tightly on it, when I'm doing my own investment right now, is I know the competitive space and I know the customer mindset really well. So it makes it easier for me to review the deck. Like I can look at those slides and call BS on them if they don't make sense, or I can look at them and like absolutely, like this is different. And then it even helps me with the total addressable market because most founders screw that up. Like I see the hideous monstrosity of like TAM, SAM, SOM a lot. Don't ever do that. It's like, I want one number. Why are you giving me three? I know two of your numbers are wrong automatically. Third, probably also wrong.
Because every investor says TAM, SAM. They always say that.
No. Like the person who came up with that, I guarantee here, I want to make people a bet here. Take $100 out of here. Who here believes in TAM, SAM, SOM? Anyone?
I'm always including it in the deck.
So here's what I'm going to do at my next conference.
Okay.
I'm going to say, who here believes in it? And people that raise their hand, great, you guys, take $100 out of your wallet and take a piece of paper out. I want you to write the definitions of what does SAM and SOM mean? Explain how they are different from TAM and from each other, and slide them forward with $100 attached to it. And if all of you have the same definition of SAM and SOM, I will pay you all $100 each. And if they're different, I'm keeping all your money. Right? Nobody understands what SAM and SOM are. The investors all mean different things if they actually say they want that. It's not true. Now, in an ideal world, one of those is your go-to-market. It's like, here's where I'm going first. That should be on your go-to-market slide. It has nothing to do with your total addressable market. Nothing at all. Total addressable market is very, very simple. And it's a bottoms-up number if done right. How many people or companies out there might possibly use your software or product times how much you're charging? Now you can, you have different price tiers. You have to come up with an average. That's fine. But you really need to understand those two things and just multiply them, and that's your total. Bottoms up. Done. Everything else is BS. Oh, there's like the entire enterprise software market in the world is these, tens of trillions of dollars. I don't care. You're not competing with all those guys. You're only doing software aimed at this. So why are you giving me this huge number that is totally irrelevant and top down to begin with? And then later, like, oh, if I only get 10% of the market, I'm like, yeah, good luck with that. That's not a plan. That doesn't tell me any number, right? I'll decide if you're going to go there. They're two totally irrelevant numbers to me. And those are the two most popular top and bottom TAM and SOMs that I see. Yep. Right? If I'm very, very, very lucky, the SAM is correct. Usually not. Anyway, end rant. Who else would like me to crap on something before we go in 5 minutes?
Oh, feel free to crap on anything you want. This is fun.
No, you got it. Listen, I see people are kind of trickling out, and I got to call in a minute or two. If we have one more quick question, I'll grab it. And if that's enough for people, a little me goes a long way in some cases. That's cool too.
Or if you want to leave us with some pithy words of advice, that's always appreciated too.
Oh, like crapping all over TAM, SAM, SOM wasn't pithy.
Oh yeah. Okay.
Okay. What's a pithy word of advice? I think the third thing that a lot of I covered TAM. So the fourth thing that a lot of startups mess up, but it's not irredeemable, is their ask slide.
Yeah.
They mess up their ask slide. There was a thing a couple of years back where they just didn't put the ask in. Like, oh, you have to ask me. I'm like, why? I need to ask that. So why do you take it out? Fortunately, that seems to have passed. I get a lot of like, we're raising X dollars. Here's what we're going to use it on. Like, that's not what I need. Like, obviously I need to know how much you're raising, but I need to know what I'm getting for that, not what you're spending it on. So what I'm getting for that is, what are the next milestones you hope to achieve, and in what time frame? Because I need to know that that's actually getting you to a meaningful destination, right? So if you're like many startups, you're going to need to raise another round. I need to know that those milestones are enough to satisfy the next guy down the road's needs to be investable. So a really, really good ask slide, and sorry, a correct ask slide has the format: we are raising X million dollars to get to Y million dollars in annual recurring revenue by the end of 2026, or whatever the goal is, right? And whether it's, annual recurring revenue or cash flow positive, your milestones can be a little different. Your time frame is usually 18 months. It could be a little less, it could be a little more. If it's not 18 months, prepare to be getting questions on that, because you have to explain why. It's kind of standard. And then, and only then, once I have that as an understand, oh, you're trying to get to like this milestone in this period of time, then I can look at the use of funds on the body of the slide and ask myself, is that a reasonable use of funds? Will it get them to where they want to go? Because that's the how, but I need to know the what first. The what and the why come first. So that's critical. And the only other thing I will say is, a lot of them sometimes say, oh, we're raising $5 million on an XYZ valuation. I'm like, yeah, don't put that in. That's a rookie error. Unless you have a lead investor and then it's legit and they, followers are coming in, your lead investor will tell you what they're willing to fund you on. Safe, convertible note, priced round. They'll give you a cap or a valuation, and you can either take it or leave it, or better yet, get other term sheets, and then you have leverage to negotiate. So the ones that put in those like, oh, raise that, I'm like, okay, why? Where's that number coming from? Do you have a lead? No. Oh, so it's just what you want. I'm like, yeah. I'm like, that's cute. That's cute. I'm going to ignore that.
I appreciate these clarifications. Thank you.
No problem.
Oh, seriously.
And I know I've seen Bonnie's deck. She does the ask slides right.
Oh, thank you. So anybody else have any last comments or questions before we let Andrew get on with his day and work on his videos?
I'll just add to that last point. If you don't ask, you don't get.
You don't get.
Yeah, don't hide that, right? I'm going to need it.
Yep. You'd be surprised at how many people forget that.
Yeah.
You'd be surprised.
True that. True that. Okay. Thank you all for having me again. I love coming on the show. It's great.
I love having you here. Thank you. And thank you for all the great advice, really.
Yeah, no, it's entirely.
Thank you. Very useful advice. And it was very good to hear about the Tam, Sam, and Som. I mean, I asked the clarifications, but I thought you had to put it there.
Yeah, and if any investor asks you about that, say, I took it out because this really opinionated guy said it was meaningless. This is my total addressable market. Why don't you, Investor X, tell me how you define SAM, because everyone defines it differently, and I'll answer your question about it. And usually it's like, well, we want to know where you're focusing first. I'm like, that's on my go-to-market. Let me jump forward.
Thank you.
Thank you.
Awesome.
Andrew, always good to see you.
Yes.
Always good.